And we know that they are going to cut, but do you know what matters more? That thing that matters more than the action they take is the tone that Jay Powell is going to take during his press conference. And that is what we want to cover today. So, hope you're ready for it. Go ahead, grab a seat, and enjoy because we're going to be here for a while. So, welcome to the program here. Reinvent ideal and shut the FUD up. It is Fed Day. We know that they're going to cut. And it's probably just going to be 25 beeps. But what we don't know is Jay Powell going to be bearish or hawkish, or is he going to be bullish and dovish in his tone today? Because that is what's the most important thing, is his tone. So, everybody's still kind of like piling in, waiting to get here. And while we're doing that, let me just play a quick ad. And then when we come back, we'll get into what I think is going to happen today.
Why does crypto suddenly explode into unbelievable bull runs, only to crash just as fast? It's not luck. It's not random. It's macroeconomics. In decrypting crypto, you'll uncover the hidden forces driving every major crypto rally, forces tied to the global debt machine, central bank liquidity, and repeating market cycles. This isn't another blockchain basics book. This is the blueprint Wall Street doesn't want you to read. The playbook that shows you why crypto moves when it does, and how to spot the next bull run before it starts. Don't miss the next cycle. Read Decrypting Crypto. Arm yourself with the knowledge to ride the wave before it leaves you behind. Decrypting Crypto by Cairo Code. Available now on Amazon and Audible.
All right, so I'm actually very early today, extra earlier than expected, because what is going to happen is they're going to announce the decision at 2 p.m., and then they're going to do the press conference at 2:30. And oh my, let me adjust the camera here. How to be a professional YouTuber, Didn't realize that it was bent up like that. But there's a couple of other things here that I think are worth talking about. I mean, to start with, let's go over the usual things in the metrics that we look at. So bear with me for a moment to get all my tabs fixed here and ready. And then we'll just share this window, Markets and Mayhem. All right, so we talked about this one last time here. Let's start with what is the general market doing all on its own right here. Well, we see that Bitcoin has retraced a little bit from, it was pushing 117,000 yesterday. It's retraced a little bit. Now it's like down to 115.8, and it's been pretty flat there all day long just because people are anticipating what the Fed is going to do. Ethereum is kind of bouncing back and forth between 4,500 and the high 4,300s. Let's take a look at the assets that I care about the most. We look at Hyperliquid. That guy is back to $55.45. I would be shocked if it falls below $50 ever again. I mean, it would take something like very powerful to push a something with as much momentum as Hyperliquid back down. Athena is at a pretty nice price right here. It's 69. Like, it's 69 cents when this thing is like already popped up to 82 cents right here. It's already shown that it could go higher. So if it just goes down to 69 when there's lots of uncertainty, that tells you how strong that this thing is. EtherFi is kind of right where it was before, not off by too much. Still severely down from its all-time high of $7.09. You see, here's the deal. Here's why I still say bull market hasn't started yet. Because an asset like this, like EtherFi, that has everything in the world going for it, and it does have so much going for it. It's got so much going for it. This one is still down over 75%. This is an asset that's going to benefit from the Genius Act and how it's planning to repatriate all of the euro dollars. It's going to benefit from that tremendously. But this asset is down from its all-time high of about $7 or almost $8. It's down from that 75% or a little more. So yes, bull market really hasn't begun. And if it already did happen and it's all over with, well, then you know when the real top was? That was in April of 2024 when Bitcoin hit its first new all-time high of this cycle of $74,000. That would have been considered the top, not this most recent one here, because everything else was pumping right along with it. So I don't think that that's the case. I don't think that's the case because it's just far too early in the way that these cycles typically go. And it was before so much of, it was before all the debt and the debt cycle that we're currently in started to get rolled over and cycled through again. So no, bull market still hasn't begun. Does it begin today? It's possible. We're going to find out. Now, how about the assets that we really care about the most? Assets in the Richard Hart ecosystem. Look at that. E-Hex is at 0.003. Isn't that incredible? Like, a lot of people thought that this thing was cooked, that it was toast, and it was never coming back. Oh, we got a pretty nice chart right here. And remember, like, when it did this pop, this little hump right here, a lot of people said, oh, yeah, it went up, and then everybody cheated and brought it right back down. It's dead. Look at that. Not only did it make back everything that it lost right here, but it gained a little bit more on top. And it looks like it still is going to pick up a lot more because it's got a long way to go to get back to like a respectable price. It's still got a long way to go for that. But man, look at this here. This is magnificent for a 1-month chart. And what I'd say is, you know, I could gloat. I'm not going to gloat. I could gloat here because I was one of the guys that always said, hey, you could just buy a little bit of everything, even the stuff that nobody likes, particularly E-Hex, because that is kind of like the least loved of all of the RH coins. It really does get like the most amount of, I guess you could say, hate. Not too many people are cool with it. But I say, well, still buy some or still hold some. You know, I say I have to buy more, but you can just hold what you do have. I don't think it hurts you to do that. And man, I got a lot of pushback on that. I don't think it was like any hate or malicious intent from most of the people, most of the critics that I had in the community kind of figuratively throwing rocks at me. And I don't attribute any of that to malice, except for a couple of jerks out there. They know who they are because they're too scared to come on here. But I'm not going to gloat about this, at least not yet. It's not time to gloat yet, because here is it's still got a long way to go. I mean, it's nice to see that the ratio is 1-3 between P-Hex and E-Hex. It's really nice to see that. But don't gloat yet. Like, the main point of E-Hex and why you should hold it is not that I think it's better than P-Hex. I do think P-Hex is better. But you see, the deal is that you just don't know which one of the RH coins is going to pop the hardest. And you don't know when each of the RH coins are going to pop. Like, yeah, they figuratively should all be going up together because of Hart's law. But still, one could have an incredible run before all the others. And it makes a lot of sense to me that E-Hex here is having the run first, just because it's the easiest to buy and it's closest to the door. And when you type Hex into a search engine, when you type in Hex, the cryptocurrency, most of the search results you're going to see are for E-Hex. Most of the stuff that's out there, because it's just been around longer. So most of the things that you'll see will be for E-Hex. And the chart that had like the best price increases was on the E-Hex chart. Now, here was something that I wanted to point out in the spaces yesterday. If you joined us for Tam Tam's spaces, you might have heard me say this, but I couldn't really show it. There's something that looked very similar to me here and really stood out. I'm going to pull this up here. So here is the first cycle that E-Hex lived through. Now let's compare that to another coin's first cycle. This is the first cycle that Bitcoin went through. And hang on, I gotta fix it here. So we got this. It's flat for a long time. Slight pop. A little more flat. And then a big run up. It goes down, then up, then down, then up, then down, 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 down slowly. Another little pop over here. And then flat for a little bit till the next cycle begins. That's Bitcoin. This was Bitcoin's first cycle. You see how this looks? Now, of course, it looks better because Bitcoin was the only thing you could buy in the very first crypto cycle that ever existed. It was the only thing you could buy. But it goes from just a little less than $1. At one point, it was a penny coin. It was 20 cents. Oh, it was actually 5 cents. Yeah, 5 cents is like the first recorded price they got for it here on CMC. So it goes from 5 cents all the way up to $30. Right? Oh, wait a minute. This ain't the first cycle. Where was this? Did I get it wrong? Okay, $1,000, right? No. Oh, no, I'm not looking at... The first cycle was 2011. Sorry, guys. How to be a professional YouTuber. Don't do what I do. Okay. As a guy, I remember, like, this thing was invented, or it was first started trading in, like, 2009. And then the first cycle it would have had would have been 2013. Kind of towards the end of it right here. There we go. There's that pop. 2013 pop. Goes up to $1,000. Very impressive. All the way towards the end of 2013. And then it comes down and down and down. All right. What other chart kind of looks similar to me? Doesn't that look a lot like this? We're flat for a long time. We're fractions of a penny. Then we have a great big run up and hit our first top. Come down and then back up. Come down and then back up and then come down. We're down for a while. We'll get another little pop later on. Over here, the 2016 cycle was already starting, so I got to cut that off. But when I do it from here, this, to me, looks similar in pattern to this. In fact, if I stretch this out more, the shape looks the same. Now, why am I bringing this up here? What am I trying to say? A lot of people think Hex is dead just because it goes up and then it goes down. And it's been down ever since. Well, that's not the first time that we've seen a coin do that in its first cycle. Now, has it been the first time? No. We've seen it happen before, haven't we? Yes, we have. Where did we see it before? What other coin did that? How about the original Bitcoin? All right. Now, it's not that we can compare the two here exactly because, yes, the fundamentals are different. The dynamics are different. I mean, you're just looking at things like supply and where you could buy these things, how easy it was to buy them and how hard it was to buy them, how much was available to buy, liquidity, everything. Not really a fair way to compare the two. But what I'm trying to say here with this is that what do you think Bitcoiners were thinking during the very first Bitcoin cycle when 2014 rolled around and everything started going down? And then 2015, when it was pretty flat throughout the entire year, what do you think Bitcoiners were thinking? You thinking that they were hopeful and like, oh yeah, don't worry, 2017 is coming and it's going to be a great year? No, they weren't thinking that. They can't foresee the future. They're not psychics. They were probably very bearish at the time, very nihilistic like we are, and probably having a lot of infighting like we do right now. And I'm not saying that that's okay, that we should all be infighting and act like a bunch of nihilistic jerks. I'm saying, guys, the path has been walked before, so it can be walked again. I'm showing this to you guys so you have hope that this is not the end. All right. So I hope that E-Hex's run itself has been giving you guys hope. I hope that, because I don't want to say hope. Hope's a stupid word, but I hope that I want to say, I believe that it should be giving you some optimism, because E-Hex was beaten up the most. It was picked on the most. Everybody lost faith in it and everything. Everybody seriously thought, well, yeah, Richard hates it, so we should hate it too, even though I really don't believe that narrative. But it's coming back, and it's doing pretty good considering everything working against it. Because there is a lot working against it, not just from the outside gatekeepers, but even from within our own community, within our own ecosystem. There's a lot of gatekeepers on it. And it's doing all right compared to the overall crypto market. When you look at bubbles, it's really the only thing that's a big green bubble, or it's the biggest green bubble on a screen that's full of red. Let's take a look at the overall Richard Hart ecosystem. So, let's see, is this updated here? Yeah. All right. Pulse Chain, Pulse X taking a bit of a hit. They're down from where they were. Because I remember Pulse Chain itself was up at like the high end of the quadruple 04, pushing quadruple 05. And then Pulse X, that was a little bit above quadruple 03. So these guys have been beaten down pretty hard here, but I mean, it's not too far from where they were. Like, you can make that distance up in a day. Inc was getting some pops, and now it's kind of retraced. And Hex on Pulse Chain fell below 1 cent. But that's all right. I mean, it's still pretty close to where it was right here, so I'm not nihilistic about it yet. Not that I don't think I would get nihilistic about it. Let's take a look at the news here to see, did they announce the rates here or anything? Not yet. Oh yeah, it's not going to come till 2 p.m., so another 2 minutes or so. We do know that and this is what I was talking about, we do know that they are going to cut the rates, but that's not what matters. What matters the most is the tone that J. Powell takes. Because if he gets up there and says, yeah, we're going to cut the rates, but we're not going to cut them anymore next time, or the next meeting we're not sure about, we're going to be very data dependent and everything. And if he talks like very hawkish in the sense that he doesn't sound optimistic about other rate cuts happening this year, that's bad. And you're going to see some pretty negative reactions in the market if he talks that way. But if he comes out here and he says, we're going to cut the rate by 25 beeps today, and it's possible that we could do more cuts before the year is over in our last 2 meetings, well, then that's good. That's going to have things really popping. You see, what they do on the day of the meeting, that doesn't matter as much as what they talk about doing for the next meeting, because that matters more. So what's this story here say? It's probably the same thing here. There will be one new Fed governor, President Trump's Stephen Miran. That's right, he managed to get sneaked in there, who will almost certainly will dissent from the widely expected decision to lower federal funds rate by a 1/4 percentage point. Well, why would he be part of the dissent? Almost certainly will dissent. Yeah. Oh, he wanted a bigger rate cut. Okay, I say, like, he would want a rate cut. But, yeah, he doesn't want a 1/4 point. He wants a 1/2 point. All right, so the push for a big cut. The 2-day meeting kicked off Tuesday, the swearing in of Stephen Miran. Blah, blah, blah. Though he has not explicitly stated where he will vote, Miran is expected to buck the committee's decision to lower incrementally. Trump on Monday again urged the committee and Jerome Powell to lower aggressively, saying on a social media post, FOMC must cut interest rates now and bigger than Powell had in mind. Okay, so he wants them cut faster. Focus on Powell. This is exactly what I was saying. However, it follows the expectations of most economists. The key question for the September meeting is whether the committee will signal that it is likely to be the first in a series of consecutive cuts. Goldman Sachs' David Miracle said in a note, "We expect a statement to acknowledge the softening in the labor market, but do not expect a change to the policy guidance or a nod to an October cut. However, Powell might hint softly in that direction in his press conference." All right. So basically, it's what I've been saying is that what matters is how Jerome speaks during his press conference. That's more important than any action that they take. Now, here's something that I didn't notice until during the spaces last night. The DXY is down, and it's down pretty bad. Or dramatically. I don't want to say down bad, because I see it's good for us if the DXY goes down. It was, you saw it before I refreshed it here, it was in the high 97s. Now it's in the high 96s. I think last night we saw it go all the way down to like 96.6. Yeah, you can see it right here, down to 96.6. And this is important, and here's why. Because it is breaking a support level that it had back in 2022, March 2022. And I remember March 2022 very vividly, because I remember that was where I stopped making money in crypto. I was still making money in crypto from the overflow of the 2021 bull run. I was in the Phantom ecosystem, and we were still able to make a lot of money with yield farming, with just trades on SpookySwap. There were a lot of DeFi protocols on the Phantom ecosystem that I was able to use and make some good money on. And yeah, even February, when that month rolled around, it felt pretty good, felt pretty rich. But then when we got to the middle of March, that's when everything went downhill. And I'm like, oh God, maybe it is a bear market starting. So we just passed where we were when the bear market started. And really, it'd be February, I think, right? February? Yeah, February of 2022. So that was still good times for altcoins. So we just went back to that level. This DXY has got to go down further. It's got to go down into the low 90s, like just above 90, for us to be in a real bull market like we've known bull markets. So we're not really in a bull market until that happens, because what's being signaled there is that the dollar's weak, and weak dollar means high crypto prices, because the weakness of the dollar is requiring more dollar bills to purchase the crypto assets. And of course, some people think, well, that just means that you buy the crypto, but then when you sell it after it goes up, you didn't really make any money. You just kept up with inflation. No. That's how stocks work. It's not how crypto works. Because with crypto, the liquidity pools that you buy these in are very small and very tight. So each purchase order pushes the price up a lot higher than just cent for cent. So I put $1 in to buy a crypto asset. That doesn't push the market cap of that crypto asset up by just $1. It pushes it up higher because of the low liquidity, particularly in the Pulse Chain ecosystem, because there's very little liquidity in all of that. Very little. That's why we like it. Where are interest rates at here for today? Let's see, is this refreshed? Gotta take a peek here. Yep, 4.04% on the 10-year Treasury. So there's still a yield spread, even with the 25 beep cut that's coming today. There's still a yield spread between the 10-year Treasury and the federal funds rate. We want that yield spread to close, and we want the federal funds rate to go below the 10-year Treasury, because here's the deal. We're at 4.4 on 10-year Treasury here, and federal funds rate is where? Right now it is at 4.25 to 450. So the spread could be 25 beeps to 50 beeps, but after today, it will be between 0 and 25 beeps, so it may as well be neck and neck with the 10-year Treasury. It may as well be. It's pretty close to it. I mean, really, I think that the yield spread doesn't zero out and flip until maybe the end of this year, if they do the 3 cuts this year starting today, in which case then they could do it. They could finally flip the yield spread and zero it out. But it won't happen today with just a 25 basis point cut. So that's why I'm not exuberantly bullish about today yet. I mean, I could always, Jerome comes out and says something positive, I will be. But I'm not that way yet. I don't want to get everybody have to get their hopes up. Don't ever want to give nobody false hope. Something I will give you, though, is a free gift just for watching me. If you want a copy of this book that I wrote, it's called Your Parents Were Wrong, Debunking and Replacing Outdated Advice. Well, you could always buy it on Amazon, but I want to give it to you for free. And all you got to do to get it for free is just head on over to my Substack, reinventideal.substack.com, and then click right here where it says free gift, and then click the subscribe button. It costs you absolutely nothing to subscribe to my Substack because everything on my Substack I release for free, at least for right now. So it costs you nothing. You ain't got to put in no credit card information or anything like that. And when you do it, you get a free copy of this book sent to you in the email. If you want to become a paid subscriber right now, because I really appreciate that, I will give you this book, and I will give you this book 100% free if you do that. So that's a little giveaway that I've got for you guys. And this here, our market cycle this is for the business cycle. Let's see, anything changed on that? Not really. Nothing changed on that, so not much to talk about there. And that is it for all of our indicators. So any moment here, the decision is going to be announced, and we can look at the statement and dissect it. In the meantime, anybody got any questions, just throw them in the chat there, and we'll get to them. And, oh, wait a minute. I got a question right here. It's from Freeman. Why is Pulse Chain lacking behind so badly these days? I want it to fly. Yeah, it's not doing very great right now. But you gotta remember, there is a rotation to all these things. I mean, don't lose hope yet, because you see, you should have hope just because of what E-Hex is doing. E-Hex is showing that, hey, these coins can pump. But you see, first, the way that it goes here is Bitcoin is first. It has its run. It doesn't look like it's stopped running yet, because really gold is first, and gold definitely has not stopped running. So first it's gold, then it's Bitcoin, then it's Ethereum, then it's the blue chip altcoins like your Solanas, Binance Smart Chain, and Cardanzos and all those. You get those running next. Then you get into the alternative chains like Pulse Chain, like Sonic. Then you get into the degen stuff. So it's a branching out, trickle-down flow that happens. So I don't expect Pulse Chain to start ripping just yet. I don't expect it to start ripping for a while because, to me, the bull run really hasn't even started yet, because gold is still running. When gold tops out, then Bitcoin should be already in its run and ready to top out. Another question up here from Paladin XYZ. Your thoughts on Tom Longo's observation that higher interest rates were being used to strangle the eurodollar and bring our cash home where it belongs? I don't think so. I mean, if that was the case here, the Fed didn't really say that was the case. And also, those eurodollars, when we look at money, US dollars overseas, where is that currently being invested in? Even with the high interest rates that we have on treasuries right now, and even on savings accounts right now, still, a lot of foreigners are opting to invest their dollars into gold. especially foreign and central banks. They're moving all that money into gold as opposed to treasuries. And even with high interest rates you can get right now on a supposed risk-free investment, a U.S. Treasury, they still want gold. So I don't think that that was the reason the interest rates were high. I don't think it was to repatriate the euro dollars, but that is why the Genius Act was passed, because the whole point of that is to repatriate those euro dollars, put them back into American banks. All right, I see Tam Tam is here. Hello, Tam, a big cheerleader. Let's see, did the decision come out yet? It should have. Yes. Oh my gosh, guys, this is great. Let me share the screen here. We got great news, guys. Fed approves quarter-point interest rate cut and sees 2 more coming this year. Guys, we could not have asked for a better outcome than this here. Yeah, some people wanted a deeper cut, but what matters is not what they do today, but what they say they're going to do during the next meeting. So they said, yeah, we'll cut 25 beeps today, and it's possible that we're going to cut 2 more times this year. Guys, we could not have asked for a better outcome. How is the market reacting to it? Let's take a peek here. Refresh. Okay, Bitcoin gets a slight pop. Oh, yes. It went from 115,000 up to 116,000. Woo-woo! What else do we got going on? Anything else popping? Not quite yet. It's all still taking its sweet time. How's Crow doing? Still at 23? Let me ask that because I bought a little bit of that today. I bought a little bit of Crow. I'm not endorsing that you guys buy it. I'm not endorsing or saying that you guys should do what I do. I'm not making any recommendations. I am not a financial advisor. I gave up that career. I do try to act with a level of care for you guys. But only because I want to say I put the douche in fiduciary. Because when I did give advice and tried to act in my customer's best interest, I was always a jerk about it because I could get away with it. I'm like, hey, I'm saying this to you as your fiduciary. But no, I'm not a financial advisor. So yeah, I bought a little bit of Crow earlier today. I also bought some Athena. Where's that? Hasn't really done anything just yet. And also some Root, because it's very low price. Like Root is a sub-penny coin, the Root network. Nobody doing nothing yet here except a little pop for Bitcoin, very temporary. I think that the market's not reacting yet because they're waiting for Jay Powell to come out and give his speech. They're waiting for him to actually do the press conference and tell us what the deal is going to be, because his words matter a lot more than the actions. We are seeing some pop happen here, though. Well, we're expecting probably to get a little bit better depending on the tone of Jay Powell. Because, again, they can make this announcement here and still find a way to screw it up. They can still find a way to screw it up. Remember December of 2024? Because there they did make a cut. And then he was very hawkish in his tone during the press conference afterwards, and that screwed stuff up. So let's see, has the story refreshed here? They added more to it? Yeah, they have. Federal Reserve on Wednesday approved widely anticipated rate cut and signaled 2 more are on the way before the year ends as concerns intensified over the U.S. labor market. Yeah, they should be concerned about that U.S. labor market because, man, I would not want to be looking for a job right now. And thankfully, I haven't been looking for a job for a long time. I haven't needed to, thankfully. I'm very fortunate in that sense. But all those guys out there that are looking for jobs, I feel for you. I don't think it's ever been worse than it is right now. DJ Cryptomatic says the DXY has reacted. Let's check real quick here. What's DXY up to? Yeah, it's still where it was before. Wait a minute, last updated... okay, this is 6 minutes late. Hang on. I think CNBC should have it live. Yeah, I know CNBC sucks. I'm not saying that I like them or anything for the fact that I use them. I just have them here because it has all of the information that I want to see. I think you might be right there, DJ. Yeah, you are. It is down. It was at, 96.73, which was actually up for the day. Now it's down to 96.43. That doesn't look like a big move, but that is That is a big move in DXY terms. I mean, first, let's take a peek here at this. At just the year to date. It's done nothing but gone down ever since January. Ever since January, it's done nothing but gone down. So this is like why the inflation fight has been very difficult. Why the Fed is so hesitant is that the strength of the dollar compared to other currencies, a basket of currencies on this, it's not been doing well against them because it was very strong all the way up here. Take a look at it year over year. It had been getting stronger from the end of 24 up until the turn of the year. It had been doing that, even while they were cutting interest rates all along the way. But now that they had actually held on to the interest rates, it's done the opposite. And this was a theory that oh my gosh, it's dropping more. This is a theory that I posed a couple of streams ago that, hey, is it possible that maybe the higher interest rates are not doing what they were meant to do? Is it possible that the higher interest expense for the companies, because they now have to compete with these higher rate treasuries by offering bonds at higher rates, is it possible that the higher interest expense for these companies is being passed along to the consumer? That was the theory I posited, and it looks like I'm right. Not taking a victory lap yet. I'm not trying to gloat. I'm not trying to gloat just yet. Maybe one day I will gloat when it's like totally confirmed and irrefutable. But I think that it's worth at least thinking about. Oh my gosh, look at this. The DXY is really going down. Guys, this is great news. This is what we want. How's the market reacting? Still not reacting quite yet? Yeah, they're waiting for J. Powell to speak before it has a big reaction. All right, so let's take a look here. Here's what changed in the new Fed statement. And expand this as much as I can. All right, so they took out all those swings in net exports continue to affect the data. That's a reference to tariffs. They took that out here. They took out a reference to tariffs at the beginning. So they say, recent indicators suggest that growth of economic activity moderated in the first half of the year. Jobs gains have slowed and the unemployment rate has edged up, but remains low. Guys at the Fed, the unemployment rate is not a good indicator of the workforce. When are you guys going to get that through your heads? Well, it looks like they got some of it through their heads because they crossed out labor market conditions remain solid. Inflation has moved up and remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks, both sides of its dual mandate. And here's a statement that they added, and judges that downside risks to employment have risen. So they're clearly prioritizing the employment of their dual mandate. In support of its goals and in light of the shift in the balance of risks, the committee has decided to not maintain but lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4 1/4%. Oh, well, all right. So it's, how's the 10-year Treasury reacting to that? Because that almost closes the yield spread on it. No reaction just yet, so they're probably waiting for Powell to talk. In considering additional adjustments to the target range for a federal funds committee, the committee will carefully assess incoming data, the evolving outlook, and balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. So that right there is quantitative tightening that they're talking about. They say the committee will reduce its holdings of Treasury securities. That's referring to the Fed's balance sheet. And when we talk about Fed balance sheet, that's quantitative easing when they expand it, when they buy up Treasury bonds or mortgage-backed securities. When they, I'm not showing the statement here. I'm sorry, guys. Let me fix that. How to be a professional YouTuber. Don't do what I do. Sorry, guys. Okay, so I got the statement up here on the screen now. And here, let's get back into what I was saying is that the balance sheet that they're talking about, or when they talk about holdings of Treasury securities, that is the balance sheet. And that's quantitative easing. When they add to it, they say they're going to continue reducing. They're going to let the bonds mature and not replace them. That's still quantitative tightening. So we're not totally out of the woods yet. We did get a good result today here, as long as Jerome doesn't mess it up. We got a good result here today, but this was it's still not out of the woods yet because the money printer is not getting turned back on, according to this statement here. They're not turning it back on right now. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. They're basically saying, hey, we'll be flexible if the facts change, our opinion changes. The committee's assessment will take into account a wide range of information. Oh, so here's what I'm hoping that they're going to say here. I'm going to turn my eyes away from it. What I'm hoping that they're going to say is they're not going to use the unemployment rate as the measure of how good the workforce is. Instead, they're going to use things that legitimately matter and legitimately tell you how good the economy is, like labor force participation. As I say, they'll take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. Well, hey, you know what's a good measure of inflation expectations? The 10-year Treasury. And right now, that is still down. So there is your inflation there is your inflation expectations. Voting for monetary policy action were Jerome Powell, John Williams, Michael Barr, Susan Collins, Lisa Cook, Austin Goolsbee, Philip Jefferson, Alberto Masalem, Jeffrey Schmidt, and Christopher Waller. Voting against this action, just Stephen Mirren, who was the only one with a dissent, who preferred to lower the target range for the federal funds rate by 0.5 percentage point at this meeting. All right. Good news there. Real good news. Let's see this. Okay, this is finally refreshed here, right? Oh, it already was. How's DXY doing? 96.4. All right. It's down. Had a little bit of a bounce back up there. Could call it a dead body bounce. All right. Now, where were we here? In an 11-1 vote that signaled less dissent than Wall Street had anticipated, Federal Open Market Committee lowered its benchmark overnight lending rate by 0.25 percentage point. The decision puts the overnight funds rate between 4 and 4.25. All right. So the only dissent that they had was just one guy, and that was Stephen Mirren. And the subject of his dissent, like the cause of his dissent, isn't that they shouldn't cut rates at all, but that they should cut by more. That's good. We like the sound of that. In a post-meeting statement, the committee again characterized economic activity as having moderated, meaning slowed down, but added language saying that jobs gains have slowed and noted that inflation has moved up and remains somewhat elevated. We knew they were going to say that. Anything in here that we're not so sure? Okay, the plot is done anonymously with 1 dot for each meeting participant. 9 of the 19 participants indicated just 1 more reduction this year, while 10 saw 2. Okay, so it's not totally set in stone just yet. It's just the majority believes they should do more cutting before the year ends. Governor Waller, in particular, has expressed concern that the Fed should ease policy now to head off future issues in the labor market. His name has also been in the mix of a potential replacement for Powell, whose term expires in May 2026. All right. This, by the way, that's why I think that the money printer doesn't get turned on before May of next year, if it gets turned on next year. But when it gets if it is going to get turned on, I don't think it happens before then, just because Jay Powell doesn't want to do it. Now, I'll be honest with you guys, honest with you as I can. I don't know that it gets turned on next year in general without an emergency, because all of the guys that are front runners to replace Jerome Powell, all the ones that Trump wants to replace him with, all of those guys have said they would only want to use it in the event of an emergency. Now, it could be that they just say that. They're just saying that because you don't want to get up there and be like, oh, yeah, I'm totally going to turn on the money printer. And I'm going to be very careless. We're going to go back to ZERP. And we're going to do quantitative easing. We're going to be printing money all over the damn place. Because it doesn't really install a lot of confidence in the markets there when you do that. Okay, so the Dow's popping. Everything else is not, though. Only the Dow. It says that it jumped 400 points and then it's sold right down. Really, everything is still waiting for that press conference. That press conference matters more than the decision and the statement. I know I keep saying it, but I keep saying it because it's true. Somebody said E-Hex was running. Let's have a look here at that. Yeah, it is higher. It is higher, all right. Let's take a peek here at the 1 month. So at 0031, that is better. You got to keep going. You got to keep on going. You see, it has so much potential just because it takes so little money to get this guy going. It takes so little. It can pop off with very minimal effort. This is why I say, guys, this is why I say, don't fade any of these assets. It's pointless for us to have the argument that one is better than the other and we should all plow into just the one that we think is good. I think it's pointless for us to have that conversation right now because, one, it's a quantitative tightening environment, so it's going to be hard for any of these assets to pop. And two, when the money printer gets turned back on, everything is going to pop. You don't know which one is going to pop first or which one's going to pop the most, but you know what is going to happen is that everybody's going to have a little bit of a pop, some a lot more than others. I want to capture as much of each one as I possibly can. That's why I'm in all of them, all right? See, I'm not a maximalist of any kind. I'm not even like a maximalist of like the entire pulse chain ecosystem. I'm rooting for all of crypto. I'm rooting for all of crypto to succeed because I'm invested in just about all of the coins out there. There's only a handful of coins I don't like. And even those, I'm not going to talk trash about them. But I'm rooting for the whole space to succeed because it's better than fiat. It's better than bonds. It's better than stocks. Better than all the TradFi crap out there. I know because I used to work in TradFi. I'm telling you, as a guy that used to work in TradFi, this new system we have here in crypto is better, even if those douchebags over at the YouTube channel called A More Perfect Union think that this is all a scam. Yeah, there's a piece of trash documentary video they made that was basically ripping crypto up, going, oh my God, it's all such a scam. Gary Gensler tried to save us from this scam, but the crypto lobbyists got him kicked out. Not one mention in that doc that Gary Gensler was butt buddies with Sam Bankman-Fried. Not literally. I don't want to give you that image. Not literally butt buddies, but figuratively, they were both jerking each other off every chance that they got, having meetings, talking about suppressive legislation that would have killed DeFi entirely in the United States of America and had it all offshored and been a threat to national security here in the United States as other countries were jumping on this technological innovation while the United States was getting left behind. So he was a threat to national security, and he's also tampered with the evidence because all of the conversations that he had with Sam Bankman-Fried got completely deleted, or the SEC says, oh, we just can't find them. So the YouTube channel, A More Perfect Union, tries to tell people now that Gary Gensler was a good guy and all of us crypto people are a bunch of scumbags. Man, I can't wait to rip that thing to shreds. I will rip that to shreds when I get time. We got some more questions here. Freeman asks, will the rise of E-Hex impact Pulse Chain and P-Hex? Yes, but not right away. Yes, but not right away, because you see, it's all going to be a sequence, because the sequence goes, as I say here, first gold goes up, then Bitcoin, then Ethereum, then the blue chip altcoins, then the degen stuff. When E-Hex, or when Ethereum goes up, what's going to be next after that is ERC20s, other tokens on the Ethereum chain like E-Hex. But when people do well with that, they're going to be like, hey, I also hear that there's other coins by the same founder that we can buy here, and he's got his own chain and everything. They will eventually rotate into the Pulse Chain ecosystem. Because you see, people are never done with euphoria and making money. I mean, a lot of people think, well, this is going to end here and it's all going to go to zero and it's going to stay at zero. When in the history of the world have people ever been satisfied with the amount of money that they made? When in the history of the world have investors ever said, yeah, I think I'm good. I don't need to make any more money. Not once has that ever happened. Not once. So you guys are going to tell me that that's going to happen this time. Well, you're telling me that human beings are about to do something that is far against their nature and is something that they've never been capable of doing. All right. And of course, a lot of people are going to tell me, oh, it's going to happen. It's going to happen, Cairo. That's what I keep hearing all the time. Can't get any of those clowns to come on a stream with me, though. The challenge is still open. Any bears out there watching? There's a bunch of you watching right now. There's more viewers than I've ever had before, strangely. But yeah, a lot of you guys watching right now, if you're bearish and you say that the cycle is all over, hit me up on X and let's have a stream where you can make your case and tell me why you think I'm wrong. Because you see, my position, it's the first thing that's pinned on my X profile. My position is that the bull market never even got started. That's this thing that I got right here. The crypto bull market is not over because it never even started. I got a whole thread here where I make that case. All the evidence I got to back that up. If you disagree with me, you think I'm wrong, first, tear through that thread, and then send me a message or hit me up on X, whatever, and tell me why you think I'm wrong and that you're willing to come on a stream where we can hash it out. Because it would be very beneficial for all the viewers to hear both sides. And honest to goodness, I would love to be wrong. When we have T-Bird on, which will be probably next week, if not, it'll be the week after. He still wants to come on. He's just got some other stuff to deal with. But when we have T-Bird on, he says the cycle has to end before this year is over. That's his position. He says it has to end by December 31st this year. And I'm going to go at it saying, I hope you're right. I want you to be right. I want you to win this debate. Please convince me that I'm wrong. That's my view going into it, because I would love nothing more than to cash out, sell all of my bags, and then pack my bags and go to Puerto Rico. Would love nothing more to do that. But can't do it. Can't do it because all the evidence is telling me otherwise. John Starline asks, what do you think about gold and silver? Well, I'll tell you exactly what I think about that. I think that they're going to continue to go up as the DXY gets weaker. Let's see, where is that at right now? Let me bring that up here. There's DXY. Is that the most up-to-date one? I don't think it is. Yeah, okay, so 96.41. It still has a way to go to get to where we believe it belongs, or where it's going to go before a bull run really gets going. Still got a ways to go. 96.41, it's got to be in the low 90s. As that keeps going down, gold and silver are going to keep going up. They precede the crypto market. They top off first. So what do I think about gold and silver? I think they still got some ways to go. I don't think that they're by any means done yet. All right. So any moment here, about 5 minutes, we're gonna have the press conference. I'll play a little bit of it here. I can't stay throughout the whole thing, but we'll play a little bit of it right here and kind of give commentary on it. But first, let me just play a little bit of housekeeping here for you guys and give you this ad here.
You're listening to a Reinvent Ideal live stream. The phrase Reinvent Ideal isn't just clever wordplay, it's a manifesto. For decades, society handed us a dusty old blueprint for life. Work 9 to 5, climb a corporate ladder, buy a house you can't afford, marry young, pump out kids, spend 40 years in a hamster wheel, and if you're lucky, retire at 65 with a gold watch and arthritis. That's the ideal we inherited, but it's a lie. A boomer-delivered illusion that made sense in 1970. But in today's world, it's a recipe for debt, burnout, and disappointment. Reinvent Ideal is the antidote. It's about rejecting the outdated script and designing a new one. A life where freedom, autonomy, and leverage replace status chasing and financial enslavement. Where your ideal isn't dictated by suburbia and social media, but what keeps you sane, sovereign, and alive. Instead of status symbols, we pursue rare and in-demand skills that buy independence. Instead of debt-fueled materialism, we choose minimalism, shedding liabilities and obligations. Instead of working to death, we embrace crypto and investments that multiply freedom instead of shrinking it. The new ideal isn't about fitting into someone else's mold. It's about building a life that maximizes your time, choices, and sovereignty. Reinvent Ideal is about giving yourself permission to redraw the map.
All right, so it's almost time. Still ticking closer to the meeting here. This might start, or the press conference, they say it may start in about 2 minutes. Let me get the screen ready here for us. And I imagine like they're going to have a shot of the podium for like a good 5 minutes before Jay Powell comes out. And everybody's like kind of noticing, like been making fun of the way he starts these meetings. He comes out and he's like, "Good afternoon." Well, we know he's going to do that today. He's going to go, "Good afternoon." What else is he going to say, though? Anybody else got any ideas what he's going to say? You guys can throw that into the chat there. What is it you think Jay Powell is going to say? I'm pretty sure he's going to use the words data dependent at some point. Pretty sure he's going to say that. Of course, he has to mention dual mandate. So that one I can't really I can't really spike the football on that one in victory when he says that, because yeah, he's going to say that. He has to. What else could he say? So good afternoon. He's going to say data dependent. Oh yeah, this is one I always laugh at whenever he says. He always when he's done talking and he's ready to take questions, he goes, "And I look forward to your questions." It just sounds like so incredibly contrived, because you know that, like, yeah, he doesn't really look forward to answering the questions from all these idiots. I'll tell you, like, some of the people that they got in the press room, they are stupid. The way that they ask the questions is such a stupid way. I can tell that, like, it thoroughly annoys Jerome whenever they do that. Whenever he has to answer those questions, I can tell that he's thoroughly annoyed by it. Okay, looks like looks like it's starting here. I'm going to bring it up on the screen. Hang on, guys. Getting it ready. It just takes me a moment because I'm such a boomer boom. All right. Let's see. Is that working? Everybody can see that? Yeah, everybody can see that. All right. Anybody got any questions right now? Is the time to get them in before Jay Powell comes out and starts talking. Now is the time. But let's see here. We know that he's going to say, "I look forward to your questions." We know he'll say data dependent. He's going to have something to say about the job market and that there's weakness in the labor market. He's going to say something about inflation pushing up here and everything. But there's certainly a lot more on his mind than just that. as we wait with great anticipation. It's like this is one of the most important things in our lives. I always say, like, oh, this election is the most important election ever. Well, yeah, it's the most important one right now because it's current, it's right now. So that's true. But you see, it's something that was like always true. You can give a statement like that, it's always the truth. Oh, man. Um, there he is. Oh, I gotta turn him on.
Squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of this slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation.
are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thanks.
It's certainly possible. We're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut because if you...
Sorry, guys, I saw that you said you couldn't hear me. Didn't realize that the microphone was muted there. How to be a professional YouTuber, don't do what I do. Here's what I was saying, though, is that Jerome says, hey, this is a restrictive policy still. This is why I'm continuing to say bull market hasn't begun yet. Bull market hasn't begun. Matter of fact, we take a look at the market right now. We got some retraces going on here, so it still hasn't gone on yet. And it looks like it might not start until the market fully absorbs all of this information here from this press conference. So anybody saying it's all over, they just don't know what they're talking about. They're just not investment literate. Get back to Powell.
You look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit. And inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting. And now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain.
Doblarus, I'll answer your question here, but let's let him finish talking because I want to give you an assessment on the whole thing, if it's hawkish or dovish.
Remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame.
I'll be honest with you guys. He sounds kind of defeated. Kind of like he really doesn't want to be in this. Like he doesn't want to be here right now. And it does sound like maybe he's got somebody breathing down his neck. Sure seems that way, but let him finish.
2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown.
What he just said right there is good. So I'm with Johnny Chaos on this here. This sounds pretty dovish.
And that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
All right. So, yeah, he does. It does seem very unusual. It does sound like he's trying to cover up a screw up here, like Johnny is saying, like sweeping dirt under the rug and kind of hoping that mom inspecting his work doesn't find out that he did that. But interesting here, what's going on is like while he's talking, the dollar index is going back up, formed a valley. Now it's spiking right back up. It's at almost 97 again. It's at 96.94, but we got to let him finish before we make any judgment about that. 10-year Treasury is holding at 4.05, and Bitcoin is down to 114.9, but we got to hold our judgments.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, we get together, we discuss we have a great discussion, and then we decide what to do and we act. But you're right there that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do.
Anybody else feel that like his choice of words is more careful than usual? I mean, he's a very carefully worded man, but it seems like his choice of words today is very careful. Like he's tiptoeing on eggshells here.
And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Yeah, Johnny, it's not just you. I get that sense here too. That, like, he wants this press conference to be over with as quickly as possible.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data. It's just that we get it a little later.
But if for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence.
Oh, it definitely is. It definitely is here. So yes, this is something that he doesn't want to say, but he knows it, and you can kind of see it in his face, that 50% of consumer spending is done by the top 10% members of the economy. The top 10% earners or top 10% participants, they control 50% of the economy. And that means that they can keep things as unaffordable for the rest of us for as long as they want to without having any effect on, like, GDP. Because, like, they're saying, well, GDP is going to be 3.4 for Q3. Is it really? It's only that good because, like, that 10% is driving it. So let's get back to him here, see what else he says. Yeah, I agree with you, Johnny. He sounds very defeated. Sounds very, like he's really choosing his words carefully, like somebody's breathing down his neck. Like, the mob is watching.
Suggests that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review.
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing. Was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
Oh, this will be.
I have nothing new on that for you today.
Didn't want to say.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median
for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Right, we're all one big happy family over here at the Fed. This is what he's trying to get everybody to believe, even though they got a new member who likely is more radical in the cutting philosophy than they are.
economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
It's not the rates that are making homes unaffordable. It's the boomers that want too much money for them.
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit. And as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're.
Ooh, this is getting really good here. This is the question we've been waiting for, because when he talks about the balance sheet, he's talking about the money printer. Listen closely on this. So the question was, if you're cutting rates, why are you continuing to reduce the balance sheet, which is the opposite of money printing? So let's hear this one out.
Still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large. So I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has three
What he basically was saying there is that the amount that he is allowing to run off of the balance sheet, the tapering, the maturity of the bonds they hold in the balance sheet, is not a large amount. It's a small amount. So they're doing the opposite of money printing, but they're not doing that much of it. So it's not saying that they're going to quantitative easing. It's not to say that they've stopped quantitative tightening, but it is saying they are doing less quantitative tightening, almost to the point where like the tightening they're doing, what he's saying is the tightening they're doing is not strong enough to have large macroeconomic effects. Guys, this is incredibly bullish.
mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Gene, we'll go to you for the last question.
That thing that he said about the balance sheet, about how they're doing less tightening than before, take a look at the crypto market. It's kind of going right back up to where it was before this thing started. It was at 116. Look, it was a little under 116 now, but it's heading back up to it. And the dollar index is falling again. So that's how important that Fed balance sheet is, because that is the money printer.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations, both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. As I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right. So it looks like that's it for Jerome Powell and his press conference. And here's the verdict on everything. That was very dovish. That was dovish. He didn't come out kind of swinging with aggression, saying, "Oh yes, we need to be higher for longer," or "We're gonna wait and see and be very data dependent," or anything. And he sounded like very nervous and careful with his words there. I mean, he's always very careful and calculated with his words, just because how much consequence the Federal Reserve chairman is going to have with any words that he uses. But this seemed like to be a lot more so than usual. A lot more so than usual. Let's take a look at how that's affecting the overall market here, right here. So where is crypto? Kind of right back to where it was before the press conference began. Everything is still kind of flat at this point, mainly because he was trying to walk a very tight rope. He was trying to walk a very tight rope. And this may take a whole day here to kind of sort out everything and digest everything that he said. But right now, no dramatic moves to the downside, so that's good. He was dovish, and they are talking about additional rate cuts this year. That's exactly what we wanted to hear. E-Hex doing very well. Not only is the price action still up and it's above 003, but it's also trending. Isn't that nice? E-Hex be trending here on X. Sure like that. I'm sure like that. So what would be like some of the bombshells that went off today during the Fed press conference? Well, what we know is that Miron, the new appointee, he wants the rates down much further. He wants them down to like 3% or almost 2.75. If he could have his way, that's where he'd have it. Of course, the president wants them much lower. And if he gets to appoint another person to replace Lisa Cook, then you'll get another person like Miron that will be wanting larger cuts as well. And here's the thing is like if they take the Lisa Cook thing all the way up to the Supreme Court, I think that the president gets his way there, because what the Supreme Court doesn't want is they don't want the Federal Reserve to have power like they're a fourth branch of government. And that's kind of like where I think that's where they would rule from, because they're supposed to determine what is constitutional and what is not. There's nothing in the Constitution about having a Federal Reserve or a central bank. And they would say, well, the Fed shouldn't be independent, because then that is a fourth branch of government that should be held accountable to a president or some branch of government. So they would probably rule in favor of Trump. And who knows how much power they're going to give the president there. Like maybe they're going to say, oh, yeah, he can fire anybody at the Fed for any reason he wants to, in which case then he'd get rid of all the dissenters or all of the ones that are slow to cut, and then put in people that want larger cuts ahead. And oh my gosh, then in that case, then yeah, we get the bull run going quickly. How's the DXY reacted here? It looks like it's kind of bouncing around back and forth. So it's still below 97. We got to take a look here at the... See, here was like the drama from earlier. It first fell right off a cliff down to 96.25. So this was pretty close to getting into the 95 territory. But then it ticked all the way up while he was speaking to 96.99, almost crossed 97, but then it went back down. And it's kind of oscillating right there, trying to find a place to stay for now. You see, it was pretty flat all day long up until the meeting, up until the announcement. But now it's kind of like back to where it was. So no progress on DXY just yet. And no progress yet on the 10-year Treasury. They are staying here at 4.05. This is all right, though. Federal funds rate is a lot closer to the 10-year Treasury. We're almost neck and neck between those two. The spread between the two of them is getting shorter. We want that spread to not only get shorter, we want it to be totally eliminated. And for federal funds rate, which is about right here, 10-year Treasury here, we want federal funds rate to come down here and 10-year Treasury to go up here. Because when they flip, that precedes the bull markets that we're used to having. That's how it's played out historically there. And I see that we're going to have some questions coming here in the chat. And why are 20-year-olds asking all the questions, asks Angelo. Yeah, here's what I think it is. It's like, when it comes to the press corps and everything, is you send the prettiest person that you have to the most important press conferences, because they're most likely to stand out and get their questions called on. They'll catch the eye of good old J Powell when they see a attractive 20-year-old girl just out of journalism school there. All right, so far, not that much impact here from this, but I do think this was kind of like the best thing that we could hope for today. I do think this was the best outcome that we could have asked for, considering the circumstances. And we would take a look at like some other things that was said. I mean, the big bombshell that he dropped, I don't know if we could really say it's a bombshell, because like it's acknowledging reality, is the revised jobs numbers mean that the labor market is no longer solid. It's no longer strong. It's no longer resilient. We cannot continue to spread that crap, or he cannot continue to spread that, oh, this is a resilient labor market. You can't say that no more. because it's not. So it's good that they finally acknowledged reality. It took you a while, but thank you for acknowledging reality, finally. What else can we take away from this Fed meeting? Like, what else was a big standout? We get to like the thing he said about the money printer, but here's what we have here is that the tone was very dovish, and the 30-year Treasury yield has been like the real volatile one here. Let's pull that up, actually. Where is that? I have to go to CNBC for it, I think. Do they even have it? I don't think they have it. Well, they have it, but yeah, so 10-year Treasury yield rises. But what about the 30-year Treasury? Of course, that's going to do something. It has to, because anything that has that much of a duration to it is going to be very, very volatile. Don't think anybody has got the chart. Somebody's got to have the chart. Okay, here we go. I think I found the chart. Let's have a peek here at what it did for the day. Oh, yeah. Yeah, this is a very dramatic chart to look at. Check this out. So, before the decision comes out, it goes all the way up to 4.64 and then all the way down to 4.6. That doesn't sound like it's a lot, but it actually is a lot here in Treasury land because these treasuries are trillions of dollars. Trillions of dollars here. So, this was up at like 4.68 or 4.69 and then comes all the way down to 4.6. So, a good 10 beeps going on there. That's a big deal for a 30-year Treasury. And when it goes up, that high, it drops sharply like that. A collapse in just minutes. And then, the 2-year also had a pretty dramatic fall as well, going from like 3.56 to 3.48. A lot of that's just due to algorithms reacting to the cut and removing a 50 basis point cuts inflationary risk. As they see, a lot of ETFs that trade in treasury bonds are just run by algorithms and computers. So that was just the computers doing what they do. Yields rebounded later. All right. For stocks, like the Dow rose for 400, but it was already rising. And it's only up about, 200 now. And really, the Dow's not a great... Yeah, it's up 266. The Dow's not a great index for tracking the market, though, because it only contains 30 stocks. Gold hit new all-time highs. Yeah, gold's doing very well, and I think it still has a lot of runway left here because the dollar's going to keep getting weaker. All right. Bitcoin is kind of back to where it was before the meeting began or before the press conference began at 115,800, 115,700 now. We got to give it a day here to absorb all the information before we kind of render a judgment on what does this do for the future of crypto. Now, it's all because of the 900,000 jobs revision. We do expect that the yields will keep getting lower because there's going to be reduced growth and inflation expectations. So that 10-year Treasury will come down along with the federal funds rate. So it might be a while before the yield spread is closed out completely and before the bull run really begins. So we can do like a trend following, not to say strategy, but we can follow the trends here for a little bit. I think that we keep an eye on that yield spread for the next 3 months. That will tell you probably exactly what to do with your portfolio. Yeah. Powell's speech was very dovish. He was focusing on the dual mandate and talked about rising unemployment, the slow job growth. He also talked about inflation and how it was a little elevated with 2.7 personal consumption expenditures. And he says it's driven by tariffs. And he also expects a one-time price level increase from tariffs, not persistent inflation, though. He doesn't expect persistent inflation. That is very good. And they do believe that the federal funds rate will be down to 3.4 in 2026. That was probably like the only hawkish thing here said so far, is that the federal funds rate may only get one cut next year. If that was the most hawkish thing that he was going to say today, that's what I'd want him to be hawkish about, because it's too early to make projections about the year 2026. It's way too early to be making those projections. Matter of fact, what else they did today here was they came up with this thingy. You guys ever seen this here? Where is it? You probably I kept hearing him say, "Oh, SEP says this, SEP says that." And you're like, "What's SEP?" This is the SEP, the Summary of Economic Projections. It's basically a forecast that the Federal Reserve does of the entire economy. And let's see, the ones that we want to look at here will be changes in GDP. This was like the report from where it was, but let's see, they got the projection for like where they think GDP is going. I know it's in here somewhere. Yeah. In here somewhere. Well, that's all right. Ain't got to look at that just yet. Be looking at that later. But yeah, so far, like this, it's probably the best that we could have gotten today, just based on like the situation of where we're at here and everything. And when you're looking at the unemployment and how the Fed is wanting to focus on it, it's kind of flawed. I mean, if you got a scenario where 100 million workers leave, and maintaining, it's actually going to still maintain the unemployment rate where it's at while tanking the economy. So looking at the unemployment rate by itself, that's a flawed way to kind of measure how good is the jobs market. And it seems like Jerome Powell is finally realizing that. Because you see, the thing is like unemployment doesn't look at everybody that's unemployed. That only looks at people who are looking for work and can't find them and are filing claims. And that's not good enough, because there's still a lot of people out there who are unemployed and out of work. And they'd take a job if they could get one. They just stopped looking. All right. Now, with the new Trump appointee, we don't really want to think, we can't really say that he's a yes man. I mean, of course, he's there because Trump wanted him there. But I think that Trump's belief that the Fed controls the entire yield curve, it's not really true. Because you look at what we just saw here today. They reduced the federal funds rate, which is on the short end of the curve, and the 10-year Treasury yield went up, which is on the far end. So that doesn't really make me think too much about like yield curve control is going to be the third mandate of the Federal Reserve going forward. All right, let's have a look here at the market here again. How's that doing? Still just kind of where we were. Doesn't look like anything dramatic is going to happen yet. If you guys got any questions, get them in now, because we're going to be wrapping up here. But yep, I mean, it's nice to see that we got some green here, but still, this isn't a blowout yet. There ain't no blowout happening here. This is all just the market kind of going back to where it started. All right. Now, what I like, though, what's making me happy is that Hex has stayed above the... I think I got to refresh it. Stayed above... It still ain't... what is it? Okay, there we go. It stayed above 0.003. That's good. So it has some strength here, and this is E-Hex that gets the least amount of love from most of the rest of the community. Good there. How's that dollar index doing? Well, I should look at it here on CNBC, because they got like the most up-to-date info on it. Any major changes? Oh man, going back up to 96.90. Yeah, I don't particularly love this. So, I gotta maintain my position here, guys, that it could take a while before the bull run really gets going. If you saw my debate with Pedro on RH Max's channel about when the bull run starts and when it ends, I still maintain that position. It could take another 6 months, another year. Worst case scenario could take 18 months before that money printer gets turned back on. Now, there could always be something that causes them to have to do an emergency meeting and cut the rates further and turn the money printer back on. There's always something that can have that happen sooner. But at this point right now, nothing happens yet. And the real bull run still has not started. But we could get some more positive reactions from the crypto market within the next few days. But really, I think that we still have a very difficult September to get through because there's still so much uncertainty, so much economic uncertainty for the month of September. That's why it's usually bad for crypto. We got a lot more stuff going on here. There's some more reports coming. There's a report coming tomorrow on jobs. There is also a lot of companies that will be ending their fiscal year. The federal government itself ends its fiscal year on September 30th. There is a possibility of government shutdown if they don't pass a continuing resolution to keep it going. And the September 30th is also the something really big from the Treasury. I forget what they call it. It's like the summary or the quarterly refunding report for the Treasury that comes on September 30th. So we still have a very difficult month throughout the rest of September that could keep us chopping sideways for like a lot of you guys are joking in the chat there for the next 2 weeks. We always say 2 weeks, 2 weeks, 2 weeks. Well, in this case, it's actually true. It could be another 2 weeks here before we get any real action because in 2 weeks, October starts and we have all of September's uncertainty behind us. So that's the way it looks like it's going to be going here so far. And let's see, I don't see any questions in the chat. So I think that's going to wrap us up here for today. Which you will see me, you'll see me some more next week. And of course, you'll see me on Tuesday's Twitter Spaces with Tam Tam and RG3. Aside from that, though, that's all I got for you guys today. So keep trucking along. That is it for us today, you glorious degens. Smash that subscribe button to join the rebellion, and follow me on X at reinventideal for more unfiltered truth bombs between live streams. And if this was your first time listening, head over to reinventideal.substack.com, because I have a free gift waiting for you there. If you become a free subscriber, you'll get a free copy of my book, Your Parents Were Wrong, Debunking and Replacing Outdated Advice, packed with the wisdom to outsmart the system. It's absolutely free to join, so no excuses. Grab it before the suits catch on. And remember, the bears get blocked right here and told to shut the FUD up. Until next time, this is Cairo Copeland, your